Good evening, Canada. It's 7 o'clock in the Eastern Time Zone, and welcome to the final installment of the Investor's Guide to Thriving for 2021. Well, as the second year of the COVID pandemic draws to a close, it's hard not to wonder what 2022 holds in store for us. After a near 12-month-long battle between the virus and the vaccines, all eyes are on Omicron as the markets and central banks wait to see if we'll need to reach for even more debt, or if this strain will prove less dangerous, albeit more contagious, and crowd out the deadlier strains of COVID, possibly heralding a return to a new normal as COVID may fade into being just another variant of the seasonal flu. On a positive note, the holidays are just around the corner, and for those of you who celebrate Christmas, at least in this audience demographic, the thing you'll probably wish for most is more yield for your portfolio. And if that's the case, you may have tried stuffing your stockings with preferred shares to get a bit more yield-tide joy. Tonight, Laura Tasse, Vice President at BMO ETFs, joins us to discuss how ETFs can help you get efficient exposure to prefs and money market. And Larry Berman is going to explain why real yields matter, which is the rate that you're getting after factoring in the rate of inflation. Larry will explore the pros and cons of private credit, the alternative to fixed income that most of the world's pension and endowment funds have been switching to. But before we get on with the show, I'd like to take a minute to acknowledge the sponsors and supporters of the Investor's Guide to Thriving, which are BMO ETFs, who have been our partners in ETF education since we started the Investor's Guide to Thriving back in 2009. And our group of companies, which includes ETF Capital Management, where Larry manages ETFs and funds of ETFs in partnership with BMO. And we work directly with clients on portfolios of $1 million plus. You can learn more at etfcm.com. Q Wealth Partners is the fintech and portfolio management platform which powers ETFCM and our rapidly growing network of partner offices across the country to deliver the next level of client experience. You can learn more at qwealth.com. And lastly, but perhaps most important, Investor's Guide to Thriving is brought to you in support of the research efforts at Sick Kids to find better cures for childhood leukemia, and the Baycrest Foundation, where we support their world-leading Alzheimer's and dementia research efforts. If you'd like us to match your donations, please use the links in the survey you'll receive after the event, or visit investorsguidetothriving.com and use the links you find there. This is how we're able to track and match your generosity. Well, that about wraps up the housekeeping segment of tonight's broadcast, and I'm sure you'd all prefer to hear about investments. So I'll see you next year and pass the mic over to Laura Tasse from BMO ETFs. Laura, the virtual stage is all yours.
Great. Thank you very much, Jared. And good evening, everyone. Thank you very much for taking the time to join us tonight. My name is Laura Tasse, and I'm an ETF specialist with BMO Exchange Traded Funds. So tonight we wanted to talk about preferred shares. Over the last few months, and not just the last few months, but even the last couple of years, clients are looking more and more for yield, given where we are, with the yields at historical lows. Everybody's looking to generate yield, and many of you may be very familiar with our covered call solutions, and those are fantastic solutions. However, if you're looking for something that's a little bit different and that can act as a diversifier for your portfolios, the best way to look is to consider preferred shares. So maybe we can start tonight by just going to the basics of preferred shares. Many of you may be familiar with them, but for those of you that are not, let's start with what a preferred share is. Preferreds are hybrid securities that have both stock and bond characteristics. Like stocks, they represent an ownership interest in a company, and like a bond, they have a par value and they pay a fixed distribution rate. However, they rank higher than stocks, but lower than bonds in a company's capital structure. Preferreds are a great tool in portfolio construction because they have a very low correlation with both stocks and bonds, which contributes to portfolio diversification. As we mentioned earlier, preferreds have a fixed dividend rate, which and that yield is very tax efficient. The preferred share dividends qualify for the dividend tax credit in Canada, so that makes them very tax efficient. And they also have a lower volatility than equities overall, due to their low correlation to everything else in a portfolio. That makes them a great diversification tool. So the preferred share market in Canada has grown significantly over the last few years, and it's now over $67 billion in assets under management. Preferred shares are typically the most cost-effective ways to raise capital for a company, because the companies can use them to raise capital without diluting their common share base. There's 4 types of preferreds in Canada: perpetuals, floating rates, rate resets, and retractables. The rate resets and perpetuals make up most of the preferred share market. And when you look from an interest rate risk, we're going to go through all of them individually. But when it comes to interest rate risks, the perpetuals have the highest interest rate risk as well as the highest credit risk. So let's look at each of them individually to kind of get the rate resets represent about 76% of the market, while the perpetuals are about 20% of the market, and the retractables and floating rates, the rest of it. So perpetuals, the easiest way to think about them is like a bond. They're very similar to bonds because the dividend is fixed through the course of the issue. They have no fixed maturity date. They can be called by the issuer at any time. But the fact that they don't have a maturity make them very sensitive to interest rates and credit spread changes if the issue is not expected to be called. So perpetuals, as I mentioned earlier, make up about 20% of the preferred share universe in Canada. Floating rates pay a dividend that flows to a reference rate. Rate resets, which are the largest proportion of the preferred share market in Canada, these pay a fixed dividend rate until the next reset date. At the reset date, they're either called by the issuer or they're reset at a new rate. And as I mentioned, largest and most liquid part of the Canadian pref share market. And retractables, very small portion of the market. They allow the holder to redeem it at par on a specified date. So let's talk about, a lot of our clients are using rate resets to create a laddered portfolio of preferreds in order to protect against a rise in interest rates. So you can think of laddering preferreds the way you would ladder a bond or the way you construct a bond or a GIC ladder. And for simplicity purposes, let's think of a 5-year bond ladder or a 5-year GIC ladder. So you can do this by splitting the portfolio by calendar years evenly. So let's say if you do a 5-year rate reset ladder, you would split the portfolio in 5 term buckets, so each of them corresponding to a year. And within each term bucket, you would place all the rate resets that have a reset date in that year. You place them together. So that way you can ladder 5 years with all the rate resets laddered or grouped together in a specific year. This may seem simple in theory. However, in practice, just as you probably know, you probably have the same issue with bonds. They're very difficult to ladder in practice because sometimes they're very difficult to source. There may not be enough inventory, and we actually have a lot of clients that realize that laddering preferreds on their own can be quite difficult. Also, liquidity is a risk that clients have to deal with when laddering individual preferreds. So an ETF can be the answer to accessing preferred shares. So if we can move on to the next slide, we can look at the benefits of using an ETF to access preferred shares. So as you probably know, if you recall from previous presentations, we talked about the liquidity of ETFs. And the ETFs actually provide you with two levels of liquidity. You have the primary liquidity, which is the trading that you see on the market. So that's ETFs changing hands from one client to another. But then you also have a whole level of secondary liquidity, which is provided by market makers, which are designated brokers that create markets or create units of the ETFs. So with preferred shares or bonds, where you have limited supply and hard to access inventory, and sometimes you have issues that are of either bonds or preferreds that are issued but then don't trade again very often. If you want to do that individually, may be very difficult. You may have very wide bid-ask spreads, so very thin liquidity. An ETF can solve that. So as you see, we're using here the ZPR example. You have a bid offer spread of about 1 cent, whereas the underlying you can have a 6 cent bid-ask offer spread. So with an ETF, because of that secondary liquidity, you can easily trade an ETF ladder, and that also attracts larger institutional investors. When larger amounts of money come into the market, that actually provides additional liquidity to the ETF. So the preferred share market is another area where ETFs bring in innovation and increase the liquidity of that market. So let's talk a little bit about the U.S. preferred shares, because this is one area where we've seen significant interest over the last year or so. U.S. preferred shares are a little bit different than the Canadian preferred shares. Most of the U.S. preferred share market is perpetuals. About 99.5% of the U.S. preferred share market is perpetual. However, and as you recall, we said perpetuals tend to behave a lot more like bonds. However, U.S. preferred shares are issued at wider spreads than Canadian preferreds, and they're also callable after 2 years, which make them act a lot more like a credit product rather than an interest rate sensitive product. So that actually increases the diversification benefit of adding U.S. preferreds to a portfolio, because your correlation with the rest of the asset classes decreases. So that makes it a great diversifier. Again, U.S. preferred shares are very difficult to access for Canadian investors. And again, an ETF structure can provide you that kind of access to U.S. preferreds. The benefits of U.S. preferreds: higher dividends. The way many of our clients consider U.S. preferreds is as an alternative to U.S. high yield bonds. So you have a very similar yield to U.S. high yield bonds. So higher dividends. However, keep in mind that U.S. dividends do not qualify for the Canadian dividend tax credit. So here you're not getting that tax benefit, but you have a higher credit rating than you would with U.S. investment grade bonds. Also a different credit rating than the Canadian preferred shares. You have less volatility because of that callable feature. They're callable after 2 years, so that gives them a little bit more stability in the market. And because of the lower correlation with the rest of the asset classes, so both equities, fixed income, as well as Canadian preferred shares, you have a lot more diversification benefits. So if we can move on to the next slide, here we wanted to highlight a couple of examples of way to access preferred share ETFs in Canada. Of course, we're going to highlight ZPR, our ladder preferred share ETF. ZPR is a 5-year rate reset ladder. And as we talk about laddering preferreds, it has 20% of the portfolio in each year over 5 years. So every year, 20% of the portfolio, or a fifth of the portfolio, is going to be reset at the new rate. So this makes it a great solution for a rising rate environment. Of course, we highlighted some of our competitors here. CPD, the iShares Canadian Preferred Share ETF, that's the universe of preferred shares. So here you're going to have not only rate resets, but you're going to have also perpetuals. You're going to have retractables and floating rate. And then some of the active solutions, the RBC, Dynamic, Horizons, One thing to highlight here, when it comes to preferred shares, once an ETF reaches close to $1 billion, you pretty much become the index. So you're not going to see a whole lot of diversification or a whole lot of difference among the 4 ETFs, because there's not a whole lot of different product to access or different preferred shares to access. So I think once you figure it out, the type of exposure that you want, so whether you want rate reset or you want to have some perpetuals and a combination of preferred shares, probably the most important consideration should be the fee. Once you have 4 different products that are going to offer you the same benefits, probably you might want to look at the fee you're paying for the exposure that you're getting. So moving on, before I pass it over to Larry, just wanted to highlight one of our newest offerings, the money market ETF, ZMMK. We launched this on December 1st. This is a great solution for those of you that have some cash that you just want to hold on to until you want to deploy it. Great way to have a stable offering where you're earning some yield. The yield to maturity here is about 30 basis points, management fee 14 basis points. Very high quality and stable solution for just for the more conservative clients or those that are nervous about where the market is going now and maybe waiting to deploy some cash. And before I wrap it up, I also wanted to highlight our Market Insights webinar every Friday at 1 p.m. So tomorrow, another webinar. And with that, I will pass it over to Larry. Thanks, Larry.
Well, thank you very much for that, Laura. I'm not going to let you go just quite yet. The one question came in as it pertains to preferred ETFs, and I'm sure I could answer it, but I thought I would bring you in for this one. So someone's asking, what is the difference between having a preferred ETF and a covered call ETF? You had mentioned covered call ETFs. They use the example of QYLD, which is a NASDAQ 100 covered call ETF. But they're just saying, if I'm trying to get yield, what's the difference? And from my perspective, it's the volatility of the underlying asset, where I think you had made a comment that preferreds are going to have significantly less volatility than broad equity covered call type ETFs. Is that true?
Yeah, and I don't know if I would say significantly less, because obviously, you know better than me what happens in the market. But I would say that with the covered call ETF, especially on the NASDAQ, for example, you're going to be protected when the market corrects. Let's say you're going to be protected by that amount of the extra yield that you have. But then you're going to participate in the market. So I would say a covered call ETF is classified as pure equity, whereas preferreds, I would say they're more of a hybrid solution. You have a lower correlation to pure equity than you would with a covered call. So I would say they would be more complementary than as a replacement. It really depends on what the client is looking for, and if the higher yield is what you're looking for, maybe you go with the covered call. If you're a little more conservative and you want to kind of diversify your holdings, probably a preferred share complement would make sense. So it really depends on suitability for each client.
Right, and I would add to that too, as it pertains to the volatility and sensitivity. The NASDAQ is very sensitive to falling interest rates. And that would almost be in opposition to rate reset preferred. So when interest rates are expected to fall, the rate resets preferreds actually don't do very well. So, if you would combine the two of them in your portfolio, you would tend to see rate reset preferreds fall as interest rates are falling, but typically that's going to be bullish for NASDAQ type stocks.
Yeah. And the other way around, if you're expecting a rising interest rate environment, probably rate resets would do a better job at protecting against that.
Yeah, so it's hard to make a direct comparison. It's a good comparison from a yield perspective, but from a what impacts the underlying securities, they're very, very different. So hopefully, Howard, that
Absolutely.
answered your question. And again, thanks to Laura, and thank you so much to BMO for being just a great partner over the years and for this season. And Laura, be well. Happy holidays to you.
Thank you,
And to
Larry.
Brad, and I look forward to seeing you at some point live again in what would be the other side of the pandemic as we come out of it, hopefully next year. Thank you.
Same here, Larry, and thank you everyone for taking the time tonight.
Great. Okay, so another quick question on preferreds, because I'm not going to tend to come back to it at the end, but I will if there are more questions. What percentage of preferred should you have in your portfolio? These are great questions, and the answer is depends on you. It depends on your sensitivity to volatility. It depends on the different part of the business cycle. For some people, as a diversifier, 5, 10, 15%, 20% perhaps. For others, that might be too high. Again, it has a different risk than bonds. It has a different risk than equities. It is a hybrid from that perspective. So you'd have to judge accordingly. If you think about, well, what is the world? Well, the world of fixed income and credit is massive. The world of equities, of course, is massive. The world of prefers is relatively small. So again, on a 100% portfolio, if bonds are half, stocks are half, how much should preferreds be? Again, you're looking at 5 or 10% as it pertains to the size of the world. But that is a good question. Okay, so tonight's topic, and I would argue that throughout the 10 weeks that have gone by so fast, you wonder where time flies these days. This might be one of the most important talks that I'm giving. And the reason is this is an asset class that I think is going to be more prominent in the next decade than it was in the past. 2 decades ago, this asset class existed, but there was no real good way to get access to it. In the United States, there was a law passed by Congress for the support of business development corps, and that is basically the structure of private lending. You have probably heard of the BDC here in Canada, which is an entity backed by the government of Canada, i.e. the taxpayer. And what the Business Development Corp does is it accesses credit markets to small and medium enterprise businesses that otherwise don't have access to lending. They don't fit in the traditional model that our banks like to look at. They're too small for public issuance, i.e. they can't go to the public market and float a bond or float a preferred that investors will buy. The cost of public market listing and everything else is very expensive, including equity, and not small and medium enterprise companies just don't have access to that typically. So your public market ability to borrow or expand your equity is small, and hence the private markets. You can go to a bank for a loan, but if your business model doesn't tick the box that the bank credit department puts us in, whether you're an individual and you need a mortgage, or whether you're a company and need a mortgage and need borrowing to expand your business or to bridge a loan because you want to buy a new property or you want to take money out of your house equity to help with business or something else. But again, you don't fit in the box of a typical financial institution. you have these private markets. So there are lots of pros and cons. I'll touch on some of them. And really, why is this asset class so important? Because of the challenge for yield and how to generate yield in your portfolio. There isn't a week that goes by where I don't get a question that sounds something like, Larry, my bonds don't pay me enough. What should I buy? And a lot of people are asked, well, is there an ETF that I could buy? And so people have gone to these covered call ETFs. This is the essence of the question that Howard has asked tonight, where should I buy the NASDAQ with a covered call so that I can get yield? That yield, Howard, doesn't come off the dividends of the underlying companies. It comes off the volatility of the stock market. And because the NASDAQ is more volatile than the broader markets, the premium earned is much higher. So it appears you're getting a nice, fat, juicy yield. And while equities are going up, there's no problem. But when the NASDAQ has its next bear, you don't want to own Q yield. In fact, preferreds would fit very nicely perhaps in that environment. But if interest rates are falling rapidly, reset preferreds don't do well, and perpetual preferreds do much better. So again, you've got these different types of asset classes. They all generate yield, but none of them, and I mean none of them, even preferreds, generate today a yield that's greater than the rate of inflation. And that is the biggest problem for asset markets and for investors for probably for decades to come. So I want to take you a little bit on a dive into the difference between the public credit markets and the private credit markets. So we're talking about corporations, generally speaking, as opposed to government bonds, because you have a risk factor. In government bonds, big, developed markets, you don't have a default risk, or the default risk is so small because all these governments can print money to pay you back. And that's obviously a big consideration. So you have investment grade credit, you have high yield, meaning junk bonds, so you can earn higher yield. Today, the public high yield market, if you looked at an ETF, and whether it's the BMO version or the iShare version or the Vanguard version or any number of them that are out there, you're looking at 4.5% in terms of yield. These junk companies historically would need to pay 8, 9, 10, 11, 12% type coupons on their debt to issue in the public market. But because the government yield is so low, negative in places in Europe and Japan, that everything else has become compressed. So high yield is very high risk from a default perspective. The reason companies have these bad credit ratings is because there's a chance they don't pay you back compared to a Canadian bank, a good, mature corporation like CN Rail or a big telco. But when the dot-com bubble burst in 2000, at the bottom of the market in 2002-03, TELUS Corp, and you would think TELUS is a big mature telco, their bonds were trading at about 25 cents on the dollar because they had a lot of debt outstanding. And listen, the dot-com bubble burst, right? So you have credit risk in credit lending, and the public markets always currently reflect the risk of the economic risk, the business risk, the risk of not making enough money to pay your interest payment, and so forth. Those are all things that are reflected in the public markets. that you don't necessarily get in the private markets. I'll talk a little bit about that, more about that tonight. You've got emerging markets, so that's a credit because emerging markets have a much higher propensity not to pay you back. Argentina, serial defaulter, right? So there's constant problems in Latin America. Spain, until very recently, serial defaulter on their debt, going back to funding the great wars of the last number of centuries. You have stressed or distressed credit markets where, again, public ability, so when a bond like Evergrande is trading at 20 cents on the dollar, so you've got stressed or distressed credit. You've got mortgage-backed securities, MBS, and so CMHC as a public version of credit and mortgages. Non-agency mortgage-backed securities, so a bank that is not an agent of the government that would issue a mortgage-backed security linked to mortgages that they've written that are not guaranteed by CMHC. Asset-backed securities. So these are securities lend like credit card debt of the banks, where they lend out a bunch of money. You've got the payments coming in off the credit cards, they securitize it, and that becomes a piece of paper that you can buy, asset-backed securities. You've got commercial mortgage-backed securities, you've got collateralized obligations. So there's all kinds of different public corporate linked securities that make up credit, okay? Credit meaning not guaranteed return, i.e. government. And so now you have this growing area of private credit where you've got the same sleeves, you've got all kinds of ways to lend. So I'm going to talk about a bunch of them tonight. And we run a fund of funds. This fund that we created a couple years ago is only available to investors on the Q Wealth platform. So we run this fund for our private investors that are clients of ours. It's not a public mutual fund. You are not going to see this asset class by way of an ETF. So I had talked about it on this week's show, and someone said, "Oh, Larry, you're running a fund on this. I'm going to wait for it to come out in ETF format." I can promise you that you're not going to see this in ETF format for lots of different reasons. The main con, in terms of the pros and cons of the private credit markets, is that they're illiquid. When you put out a loan, you can't get your money back. And this is why in the public markets, when you buy a private MIC, Mortgage Investment Corp, and I've got some examples here that I'll show you, you get volatility. The price adjusts when people want their money out. Whatever the next bid is, that's what you have to sell it at. In the private markets, what happens in this asset class is they say, "Sorry, folks, you can't have your money back." What do you mean I can't have my money back? I gave you the money, I want it out. Well, a lot of them will say, "Okay, but right now, I don't have the money to give you because the mortgages we've lent to, we can't call those mortgages," right? So you have this illiquidity issue. And this is why an open-ended mutual fund or an ETF that isn't conducive to this asset class. It's primarily the illiquidity. Now, everybody's starting to like this. More and more people are becoming aware of this asset class, and massive amounts of financial advisors are putting clients into these private funds. So there's plenty of funds out there. In our fund right now, fund of funds, we have 33 different funds. Like, wow. And I'll get into the reasons why we have that. Now, the cost of getting into these investments tends to be higher. When you look at some of the fund fact sheets, you see charts like this. So here's an asset class where the net asset value, pretty steady Eddie, pretty consistent, 5, 6, 7, 8% year after year, month after month, with not a lot of volatility. But when you look at the management fees, the all-in, what's called the advisor class series, 2.45. It's not uncommon to pay somewhere all in between 2 and 3% in this asset class. What a F class is where you pay the advisor a fee for financial planning and for advice, but there's still a cost of the underlying product. So they typically take out the advisor compensation. The advisor's charging you separately for that, but there's still a cost to owning the asset. So this is a very expensive asset class in general. There can be, in many of them, if not all of them, a performance fee over some kind of preferred yield, some kind of hurdle. They will very often have penalties. If you want your money out, you can get it, but you got to pay a penalty if it's within a certain time frame. You can see in the case of this fund is one of the funds we own. So I'm using examples today of some of the funds we already own. You can get your money out if they don't gate it, if they don't say no halting. So they have provisions in all their strategies that even if you want your money back, we can halt redemptions if it's going to impact our assets in the fund. So in this fund, you have to give them 4 months notice to say, I want my money back. So markets are falling, markets collapsing now. You say, I want out. 4 months from now, they give you your money back if they're not gated. And by that time, everything might have recovered already. So you can see the illiquidity issue is big. It's also falls into the exempt market accredited investor rules in terms of their style. And what that means is there's minimums. If you're not an accredited investor, the minimum investment into one of the funds is $150,000. So imagine how much money you need to have to get 33 different funds. And so the diversification, not only between managers, but all the different styles of investing that I've talked about already that make up these private markets. If you are an accredited investor, there's still minimums and they're still pretty hefty. So small investors are completely excluded from this asset class. Typically, those are the ones that need the yield in their and the safety in their portfolios the most. So it is a very difficult, complicated asset class for lots of reasons, but the returns on average are very, very stable. You can see the little hiccup in the NAV there in this fund. I'll talk about what that is in a few slides from now. Through COVID, in early 2020, you can see the NAV move down a little bit. But by and large, over time, the stability of the returns are very, 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 very attractive. I remember my grade 12 English teacher telling me not to do that when I wrote an essay. But I wanted to underscore the importance. So another one of the funds that we have is a private mortgage investment corp from a company called CMLS. Last week, we hosted for our partners and at Q Wealth, we had our annual partners conference, and we hosted a panel on the private credit sector. One of the panelists was the portfolio manager from this fund, CMLS Asset Management. CMLS has been in the mortgage business 30, 40 years. Very, very high-end pedigree in terms of the quality of manager that has been lending in the private. So you have two categories of mortgage investment corps generally. You have the private residential, and so that is loaning to individuals against the value of their own home. That is the lowest risk category of lending when it is done on a diversified basis. Then you have the commercial lending, and that would be lending to, say, a multi-residential, where it might be a bit of a corporation structure. It might be a strip mall. It might be a small office building. So it could be industrial. So it would be a commercial mortgage backed by the asset value of the property. So in this case, the borrowers, for whatever reason, and there's a whole host of them, but typically they don't fit into the box that the banks like to see for how much money you make. So a lot of people, business people, have business structures, and for whatever reason, they don't show a lot of income perhaps to minimize their tax liabilities, and therefore, but they can't afford, and they may own a very big house. It'd be millions of dollars, or they need to take money out to buy another property. Bank says, nope, don't want you to see the leverage. We don't like the risk, won't lend to you. So whatever the reason is, they go to this shadow banking lending market. And you may be familiar with some of the public companies like Atrium, AI, ticker symbol, Firm Capital, Timber Creek, Home Capital. I know everybody knows Home Capital. It's in the TSX Composite, First National, Equitable Group. These are all public companies listed on the Toronto Stock Exchange that trade as public investment mortgage corporations, okay? So when you look at the type of lending that CMLS does, Ontario, it tends to be proportional, but they concentrate in Ontario, but they're diversified across Canada, okay? Primarily Ontario. The degree that loans have a risk level is the loan to value. So how much equity is in the property that if the person doesn't pay the mortgage, that you foreclose, sell the property, get your money out. So the equity component, or the loan to value, is a really key metric in this asset class. Now, this is a industry that is not highly regulated. I wouldn't say not regulated. I should say not highly regulated. And so it's important that the operator has a track record. Now, there's a difference between a one-on-one mortgage where you have one property or two properties and you're directly lending to that household. But if it goes bad, you have to foreclose, you have to take over, and then you have to sell the property, okay? So that's a higher risk level than having a professional organization that may have hundreds or thousands of mortgages. So you're diversified. You can see the performance over the last decade from CMLS in terms of their fund fact sheet that recently came out for October, how consistent the distributions are. Now, over time, as interest rates move around, you know, the return you get has some variance, but overall, it's pretty steady Eddie. And in a terrible year like last year, where there was clearly some issues around people paying their mortgage, they're not working, people lost their jobs, you got served, but it wasn't enough, that the yield went down a little bit. And then this year it's bounced back a little bit. So it's not without risk. There's been some high profile frauds, which I'll talk a little bit about in the commercial aspect and the private credit areas. Bridging finance is the name recently. So it really is important to diversify, and I can't emphasize that enough. So within a fund like CMLS, you've got maybe several hundred, or even in this case, I think over 1,000 different loans. So that if a handful of them do go bad, and they do, they would have to work it out, take over the property, clean it up perhaps, put it up for sale, and typically if you're in a forced mortgage situation, you get paid out. But then there's these higher yielding mortgages that might pay not 5, 6, 7, but 8, 9, 10, 11. But those are second mortgages and sometimes third mortgages. So these mortgage investment corps will do a lot of them, but most of them primarily will have loan to values that are 60, 70% range. So when you add those two up together, in the case of CMLS, you've got close to 80% of your mortgage in a first situation where you have equity of 30 to 40%. So that if you do need to liquidate the property and sell it quickly, that there's plenty of equity and the ability for you to recover your capital is very, very high. So again, residential, commercial, this is the lowest category of risk and hence the lowest range of yield. Now again, you can get up to 7. So think about it. You're paying these guys money to administer and diversify you. So they might be charging the end unit holder on a good credit, maybe 8%. Cost to administer it, probably 1. Their fee to run it could be 1, 1.5 range, could be a little less. Again, they vary depending on who it's doing it. So net to the unit holder, maybe around 6. And so that's kind of where CMLS is. They'll have written some second and third mortgages that might be 9, 10, 11 range. And so that pulls the yield up a little bit, but increases the risk a little bit proportionally and so forth. So they would decide as professional managers of the strategy how much first to do, how much second to do, but within their documents, so someone's asking a question about how did they do during the subprime markets. So this asset class existed, but really wasn't available in public fund format. It was really for pension funds and foundations, and really wasn't available to individuals before the proliferation and really explosion of business development corps and mortgage investments corps in a public way. So you didn't have a lot of this. So Lewis, it's a good question, but you didn't have a lot of this during the great financial crisis. And there aren't too many funds that have been around. There is one called Antrim that was been around for 30 years doing private lending, but their fund that was available to individual unit holders didn't exist at that point, or maybe just had started around that time, where when you invested with them, it was in a private LP structure and they didn't really have the capabilities and liquidities, and they would launch a fund that had maybe 5 years to it, and then it matured and they would launch another fund and so forth. So the structures, Lewis, existed back then, but really not in the current form that they are today. And I would submit that the crisis of COVID was pretty darn bad shock. So I'm not sure if that fully answers your question, Lewis, but thanks for that. So when you look at the difference between the public market and the private market, remember that chart on the net asset value being pretty stable over time. When you look at the public equivalent of a mortgage investment corp that's effectively underneath it in terms of what they're doing, lending to individuals and lending to commercial interests on a mortgage basis, the volatility of the price of that public security during COVID. Okay, so you can see that many of these private corps fell, this is in percentage terms, 50, 60, 70%. Why? Because of the uncertainty. What happened in the private side? Those same risks were there, but you do not have the public volatility. Some of them gated, meaning, sorry, I know you want your money back, Lewis, but you can't get it, okay? Because they couldn't all of a sudden call the mortgage off the person. Like, that doesn't exist. But in the public sphere, the price of the security adjusts to what the next bid is for that. And so if people are panicking because they want their money out. So one of the ways to think about this asset class is the public version of this is very attractive after a crisis because you have the potential for that price recovery, not having felt the bad part about it, right? Problem is, you may not be able to get your money out if you're in the public side or in the private side and be able to stuff it into the public side. So illiquidity, again, is a big, probably the most important factor on this asset class, okay? Now, many of these have done really well. So what I'm showing you here in this graphic is the current dividend yield based on what these public MICs are paying in the marketplace relative to their compound total return. So you can see in the case of Equitable Group that in this window, which is about 2 years long, pre-COVID through to today or yesterday, actually, that Equitable Group has had a yield of 5, but an annualized total return of 15, where First National, 6.25 total, where the dividend yield was 5.77. Looks to me on this basis, Home Capital is not paying a distribution, but I'm not sure that that's correct. I would have to double check that. I just cut and paste this from my Bloomberg terminal, showing that Timber Creek is yielding 7.38 and has a total return of around 4. Okay, and so forth. So you're seeing the different returns in these asset classes. Maybe I'm lining these up wrong. It looks like I've got 7 here relative to 6. So pardon me, I might have some of those wrong, but I thought I had lined them up. There could be one in there that's incorrect, but you get the message. Sorry, so the message here is the alignment of these things. I think that 1.02 is one shouldn't be there. It's 5.77, and it's probably First National that has that, doesn't have that distribution. It's possible there. Anyways, that is really, this graphic explains the volatility of the public market versions of these things compared to the private markets. And so a lot of that sleep at night factor that I like to talk about would be part of that volatility issue. So the next class of lending, which is a risk level higher, which is still related to real estate, is the development of real estate. So not existing properties, not paying rents or have incomes for the individuals. These are development or redevelopment. Old strip mall, it's outlived its useful life. It's taken over. They level it. They turn it into a small office tower or a condo or a hybrid where there's residential at the bottom and condo on top, redevelopment. Or there's that piece of land downtown. It used to be a parking lot. It no longer makes sense to be a parking lot, and they put up a 40-story tower building with offices and hotels and retail and so forth. The banks don't like the risk from this being an idea to this having rent and tenants that are going to pay the mortgage. Banks don't like that. It doesn't tick the box. But these developers need money to build, okay? So they need money to build. So where do they get the money? They get it from the private markets. They're not paying mortgages of 3, 4, 5% today. These guys have to pay 10, 11, 12, 13, 14, 15, 16, 18% for that money, depending on their tenure, their quality, the ability of the lender that I'll be convinced, the amount of equity that that developer has in the project, meaning how much of that land, if we have to take this over, right? So here's the deal. They're building a condo market collapses. Nobody's buying condos anymore. You have $20 million of cement sitting there. They built the basement. They put up the first floor. They can't sell it. The market collapses. Think office towers in Calgary when oil prices are not doing well, right? It's the project stops for whatever reason. Well, all of a sudden that developer can't pay the mortgage. So you've got to foreclose or you've got to work it out with them. So the degree that that developer has equity at stake so that we can take over the property, we can sell it off to another developer who can finish it. Who gets hit first? The equity gets hit first, and whatever's left over goes to the creditors. So the degree that there's equity will depend on the interest rate that we're able to get from that development. So you can see that this type of lending is higher risk. So the yields go up proportionally, and they're going to tend to be 8, 10, 11, 12 net to the investor. There's a fund we're in out of Quebec. They've got what they call their Q8 fund, and they've got a Q12 fund. The Q12 fund does higher risk lending, where they're getting 15, 16% type yields. Net to the investor, 12, but it's higher risk, right? So do you want that? It could be that if they're not diversified and they've lent most of the money to one project, not that they do this, these guys don't do that. But if they do that and all of a sudden they can't pay, it could be 4 years where you don't get your interest payment until that project is sold and to someone else and they get their money out. And that money now is able to be used to lend to someone else. That's why diversification in this asset class is probably the most important thing you can do. So one of the funds that we own is a TREZ, US Yield Trust, it's called. Again, this is available to individuals. Credited investor rules apply. And they will stop taking money. Like if you want to give them money and they don't have money to lend out, they stop taking it. So I just got notice from these guys that for the next couple of months, if we want to give them money, it's got to come in this week, or we can't give them money, right? So there's going to be parts of this, and this is why diversification through the whole asset class, because these funds will either gate your money from coming out or prevent it from coming in, because they want the yield to remain. And if they're taking in all this money and they can't lend it out because there's not enough deals to do, then the yield for everybody falls, and that's not a good thing. So you want a manager who is actually going to gate your money both ways, so the existing unit holders don't get hurt, right? Illiquidity again in this asset class. What these guys are doing in the States primarily is lending first mortgages primarily. There's some seconds, there's some blankets, meaning there's a first and second component to it. It's a whole blanket piece. There's probably some equity. There's probably a couple of things. There could be some preferred, so it's more of an all-encompassing type loan. Primarily residential, so the development of residential communities, 100 houses, 500 houses, whatever. Primarily in the south of the US, Texas, Florida, Arizona, that would make up about 70% of where they're doing this development lending. When you look at the demographics and the migration patterns in the States, because of the aging population, people are leaving New York, Minnesota, the cold states as they retire, and they're moving south. They need a place to live. So the development down south is really very attractive. And so we love lending to that and getting these super juicy yields until they get to the point where that community or that condo or whatever is 50, 60, 70% leased out. And then the banks say, oh, we have some visibility. The job's pretty much finished. And now there's going to be a cash flow. We're happy to lend to you at 5 or 6%, right? For your conventional type commercial mortgage. That's when the banks say, let us in, right? But during the high risk phase, the banks want no part of this because they don't want to take over the property. They don't want to have to sell it. They're not in that business. Banks are in the business of borrowing and lending and making a spread. So if they can do that and securitize it, then they'll do that. But this asset class can't be securitized because it's too high risk, right? It's very, very difficult to securitize it because the certainty of cash flow is really low. And it would be junk status from that perspective. And that's why you're getting yields of 15%. And again, after administration cost and everything else that they do on their due diligence to these managers, the net to the investor, depending on the complications and the quality of the developer, 8 to 12%. Then we have the private credit side that is not real estate linked, and this is linked to lending to small and medium enterprise businesses. This is where that company cannot access the public markets. They're not big enough. They're not listed on the exchange. They can't list equities and get that money in to do M&A transactions, to do lots of things that would help their business grow. Maybe they're not a mature business. Maybe they don't have, the cash flow needed that ticks the box for the bank, right? So this is where the shadow banking markets come into play. They don't have access to traditional markets. So here's the fund, and the one where we showed some of the graphics for before in terms of the returns and some of the objectives of the fund and some of the restrictions of the fund. So again, you can see it's a little more lumpy, right, in terms of the returns. Sometimes when a fund like this is lending to a company for an M&A transaction, so why does that company willing to pay 12% for the loan when, theoretically they could probably do it for less? Well, good answer. And the reason is they don't want to give up equity. They want to own the business because maybe in 3 or 5 years they're going to list publicly, and they're willing to pay 10, 11, 12, 13% for money because they know that if they do this merger, the bigger company will then be listed, they'll IPO, and boom, right? So they're willing to pay more for capital to do what they need to do today to grow their business so that the cost of so they'll do it at the cheapest cost of capital. Now, here's where the business development corporation comes in. So when we're doing our due diligence with the managers of the tech credit fund, one of the questions we ask is, when you lose out on a deal, because a lot of these companies, they'll go to 2 or 3 or 4 of these funds. Sometimes there's an investment bank involved, but often not. So when Goldman Sachs or Morgan Stanley or one of the big banks in Canada puts together a private deal to raise money for a non-public company, they will end up charging a fee in the 8 to 10% range, somewhere in there, and they will get an equity kicker, like a warrant, so that when they do go public, they get performance. So sometimes these lumpy payments, like we saw in September here, could be linked to an equity kicker. That so they lent the money, the deal was successful, the company IPO'd, the warrants are now worth something, they sell them, the equity cash out, and they take the profit into the fund. So you tend to get these. Now, again, you see in this fund in February of 2020 had a loss. It was actually the first time this fund had a loss. I don't remember exactly what it is off the top of my head, but it was a very rational thing. So the further you get away from solid assets, where the assets are now senior secured, you're the most senior creditor to this company, they lose their equity, but there could be an impairment. They might not be able to pay, right? Because something's happened to their business. But you are the most senior secured on the credit stack, meaning if you have to take over the company and part of the loan will say that, listen, if you guys don't pay and you don't meet these certain requirements, covenants, that we're going to take over your company, we get seats on your board of directors, whatever, and restructure the company so that they can sell it off to someone else and get their money out. So you are very, very senior. There is equity behind it from the business owners, but sometimes deals go bad. The biggest player in this space in Canada is the Government of Canada by way of the Business Development Corp. So this is not a foreign thing, but when these guys, these private funds lose out, they're losing out to the Government of Canada because the Government of Canada can finance here, and these private credit funds probably have a slightly higher cost of financing than the Government of Canada. So the Government of Canada is able to lend, but they don't like the higher risk stuff either. And so they tend to be 8 to 11% range, where some of these private ones tend to be 10 to 15% range, maybe higher. They tend to get more equity when there's an M&A transaction involved on the other end of the loan and so forth. So the fund objective here for this fund is superior risk-adjusted returns. All the risks that you would have in a public-private credit fund. So in the US, there's probably about 50 of these things listed on the stock exchange, has the same or similar type of volatility than the public mortgage corps. So when you hit COVID or you hit market weakness, the price of the public versions of what these guys do is volatile. But the private versions don't have that same issue. But again, gating, you can't get your money out if you want it. Okay? Again, the biggest difference is that liquidity issue for the asset class. Now, within the private lending, there's the M&A type transactions, but there's other kind of lending. There's lending against assets or intellectual property. So this is another type of fund that we own. And you can see the yields on this one are a lot lower. And you would say, well, Larry, why would you buy that fund where the other one you just showed me has an average yield over 9? This one has an average yield in the 5 to 6% range. Because this lending is far more secured, because it's secured against receivables, it's secured against assets, meaning direct specific inventory that could be sold off, and the money can be recovered easier than taking over the company and restructuring it and selling it off, right? So the yield's lower. So again, very, very diversified way. So in our fund that has 33 funds in it, we have 5 that are in that residential commercial lending. We have one that just is commercial lending only. We have about 10 that are in this private credit area. And then we have a little bit of public market for liquidity. And we have a little bit of REIT exposure in there. So real estate, but cash flowing. So mortgages, but real estate linked. So you have but they're private, they're not public, right? And then we have a little bit of public in there to create liquidity, because liquidity is the biggest issue. So for my unit holders, if they want their money out, they can get it. Now, I don't expect anybody to pull their money out unless they need it for something very specific. So this is an asset class here that, again, I really, really like. And what they end up showing you is what types of loans that are out there. So in this one, senior secured short term. When they say short term, they're typically lending the money on a revolving basis. So it's like a line of credit that they're issuing. And in this case, secured by, it's a warehouse situation. It's probably secured by, a number of, I would think, given 542 obligations, it's probably against receivables of some sort. And then you've got purchase ordered, accounts receivable financing, secured demand loan provided to factoring firm. So again, they look at the receivables. What is the probability of collecting all that? They discount it for the yield they want to earn and said, we'll lend you this money so you can go on with your business, knowing that we're going to be able to recover it against your receivables over time. That's the kind of what factoring is. So that's why the yields are lower. It's much higher probability of getting your money back. And at the end of the day, when you give someone a loan, that's number one, right? Getting your money back. So here are some of the tough questions that we asked all our panelists. And on our panel last week, we had CMLS, which we talked about, one of the other funds that is run, this tech credit fund, is run by or issued by 9 Point. It's available. Individuals could buy it, but typically they're offered through financial advisors, not direct, because you have all these accredited investor rules and so forth. Again, some challenges there. So we asked about bridging. So the bridging was a $2 billion fund where there was all kinds of fraud that KPMG, top auditing firm, completely missed. The securities regulators that went in and did a review completely missed. And so you have this potential high risk for fraud. In this case, there were some inappropriate lending. There was payouts where the founders of the firm put money in their own foreign bank account. Like, oh my God. And the auditors and the regulators missed this. Now, when we're doing our due diligence, we asked them outright about what's going on in the industry. What are you sniffing out there? Where are there problems? So we ask everybody to tattletale on what they're hearing about what the other guys are doing. So we know where the smoke is. But I perfectly expect that there's going to be a fraud and there's going to be bad loans, because it's just part of this asset class. So part of the solution here is not to just buy one of them. I've seen some examples where financial advisors love this asset class and they had 20% of all their clients' money in bridging finance. They're going to collect 50 or 60 cents on the dollar from what I hear some point down the road. It's kind of having like all your money with Bernie Madoff. So this is an asset class where just putting your money with one type of investing one, higher yield, it's fine until it isn't, until there's a fraud, until there's bad loans, until there's impairments, and all of a sudden that cash ain't flowing to you anymore. Diversification, diversification, diversification is really an important thing that, minimizes the Bernie Madoff challenge, and what I'll call it that way. Maybe we can call it in this space in Canada, the bridging finance challenge. There's been all kinds of articles written in recent weeks in the Globe and Mail and so forth, and I'm sure many of you who have thought about it. So, why do you need special due diligence and oversight here? Does it prevent the fraud? No, it doesn't. It's clear that the auditor, just having an audited financial report is not enough. It's painfully obvious. Now, Bernie Madoff, there were a lot of warning signs. He was his own custodian. There was all kinds of warning signs for years. There were whistleblowers, but nobody seemed. So the only way to protect yourself from a fraud is to diversify. And what I showed you in this asset class is that in order to do that, you probably have to have several $1 million in it so that you can buy 20 or 30 different funds, right? And that becomes a challenge. So this is why you're not going to see a public security here. Now you can clearly, the question just came up from Lawrence. He's asking, he says, I'm not quite sure what you're doing here. Are you soliciting for us to invest in your version of the fund? So yes and no. So if you qualify to potentially be a client, then yes. But what I'm saying here is this is an asset class that for people who need that yield, that isn't available in the public markets, and you need safety in your portfolio that you can't get in the public markets, that you need a solution. And what I'm saying here, Lawrence, is that it's not going to come in an ETF. But I think this is such an important asset class and a growing asset class. When you look, you actually own some of this and you probably don't know it. When you look at the Canada Pension Plan, perhaps you're a teacher, you're an Ontario Teachers Pension Plan. Probably in the private credit space, you've got 10% of those pension plans investing in these things already. There are a handful of the holdings that we have in our fund that are institutional only, that individuals can't buy. So am I suggesting that people have a look at our solution here? Lawrence, absolutely. But it's an asset class where we solve for some of these problems. Hope that answers your question. But I'm trying to educate, as I always do, about what I think is an important topic. And that's really, Lawrence, what my goal is here. I would like to say, and I'm actually quite certain, you are going to see a proliferation of funds in the private credit space because of that need for safe yield come out. And they're going to have some of these gating restrictions on there. And I'm trying to educate you about some of those cons or challenges to the investment space. But it's coming. You're going to be pitched on this from all angles, maybe including me. But we've created a great strategy here. Now, if you're a do-it-yourselfer and you don't want to work with an advisor, no problem. Try to do it yourself. But Lawrence, be aware of these issues. Don't just invest in someone. Like the vast majority of people, they look at the yield and they don't look under the hood. They say, oh, nice yield, I want some of that. They don't look at the risk underneath. Can't get my money out, whatever. Potential for fraud and so forth. So I hope I gave you an honest answer there to that question, Lawrence. Thanks for that. How have the funds performed during the pandemic? We asked all our panelists this. How has it changed the way they do things? And the feedback that we got from all these portfolio managers in their various asset classes was that COVID was probably the biggest shock that they would have ever seen, given the uncertainty. Some of them halted redemptions, not all of them needed to. There's a very famous fund out there that's been in the development lending space out of Alberta called Romspin, where people just wanted out. They didn't care. They had to gate it. There were some lawsuits. This stuff happens. So just, again, be aware. So, you know, what's the worst case scenario? And there was a question earlier about what happened during the great financial crisis. And I kind of commented on that already. But this private area, when these loans are given out, it could just take time. One of the funds we're in has an impairment. The impairment's 2 years old. They have taken a small provision. So there's accounting rules under IFRS, the International Financial Reporting Standards, that if the cash flow stops into the fund, they must take a provision for a loss, which means the NAV will take a hit. So they say, okay, we make an estimate that based on the equity coverage, blah, 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 we expect 50 cents on the dollar to recover, or whatever it is. And if that loan is 10% of the fund and they're not going to recover 50, they would have to take a 5% allocation. One of the funds that we're in, which is probably in terms of quality, it's a private fund, individuals can't buy it, it's for institutional type investors only, had to write down the net asset value. Their asset class is office REIT, okay? Office REIT prime space. Can you imagine COVID hits, everyone works from home, we have no idea, and all of a sudden half the tenants or some good portion of them aren't paying their rent for obvious reasons, but because the big office towers are inhabited by law firms, accounting firms, banks in general, a lot of the rents were still being paid. But they had to recognize, because of the impairment, the net asset value of this fund was written down by 30% in the office REIT space. We didn't own the fund at the time, but we looked at it and said, are people still going to use offices? And the answer is yes, but less than before. And so how much is that worth? Is the discount in there? And we made an allocation to that fund. But this is the premium, what I would say, A+ asset manager in Canada in the office REIT space. Now, if you look at the public version of an office REIT, a lot of them are out there, those things fell 40 or 50%, okay? So, so Lawrence is following up with a question. So we would have to be your client to invest in your funds. If not, how would one access them? So you would have to be a client of a financial planner advisor of Q Wealth, somewhere in the Q Wealth system, which there's offices all across the country. So yes, this is an asset class that is going to be, if you want your money out quickly, daily liquidity, you're not going to see it. So in our fund that does have daily liquidity, it is available to partners and advisors in Q Wealth. Yes, Lawrence. Okay, so what happens when things go wrong in their different skills? So the skills needed for someone who's originating, the organizational structure. So let's say you're an individual and you're lending money to someone else. You're doing it yourself. I've got a friend who goes to a lawyer. They lend money through private mortgage brokers to an individual, one house, one loan, and they're getting maybe 11% on a second mortgage. Okay, sounds juicy and attractive. This is a real example of what happened to my best friend. Guy's business goes bad, COVID, second mortgage, first mortgage calls. So for the second mortgage to get paid, you have to buy out the first mortgage and then sell the property and hope you get your money out. This is what happened. He did that. He sold the property, took about a year and a half for that all to play out. Just recently got his money out. Maybe it took about a year, but that was the process. What had cost him in legal fees and foreclosures, and now he's got to pay the commission to sell the property. He was break even. So what he thought was getting 11% on a mortgage for a year ended up getting nothing, and had terrible headaches and tied up $1 million of his equity. So that's one of the things that happened. So it makes sense to have diversification and have a professional manager and have them not only administer the mortgage, they charge you a fee for that, but if it goes bad, have the ability to then sell the property, clean it up, manage the property while nobody lives in it until it's sold, right? And that's why the cost of these things can be very high by way of MER. So again, you got to look at the quality of what the people are doing. And that's big fact. So Q Wealth, Lauren, he's asking, so Q Wealth, you said you've never heard of it. It's relatively new. It's only been around legal structure for about a year. It is basically ETF Capital Management was the founding business. So my firm, ETF Capital Management, was the founding firm of Q Wealth. Q Wealth has now become the parent company and the official registrant, where ETF Capital Management is a company under that structure of Q Wealth. If you think of Hollis Wealth or anything else, but it is a partnership of investment managers across Canada, okay, that specifically are creating strategies customized for individuals like we do at ETF Capital Management. It's new. You're going to hear more and more about it over the coming years. But again, thanks for that question. So some other tough questions about this asset class. Given the discussions about asset bubbles, you know, how does it come to be? What if equities blow up? What if we go into a recession? All those credit risk things are big factors here. And when it comes to lending to individual companies, all the managers, they actually do this. They do the analysis. They look at the credit. It's really important. How does this asset class pertain to rising inflation? So most of the money that comes in is money from you and I, mom and pop, and individual investors, pension funds, endowments, foundations. Generally, the money's very sticky. It's long-term money. It's looking for yield. It's not fast money. It's not public market money that wants to be in and out and trading. It's not do-it-yourself investor money. It's pension type money that people need the cash flow to live off of. And typically that money is sticky. And so changes in interest rates aren't a big factor. Where there's leverage involved, some of these funds have leverage in them when they're doing their lending, that it tends to be lent at a short-term rate. The average loan isn't 5 years or 10 years. It tends to be very short. Mortgages tend to be under a year, 1 year or less typically. When it's a commercial mortgage, tends to be 3 years or less. So that as rising rates come, the interest rate reset will be proportional. So you don't have a lot of interest rate risk. And by way of inflation, because of that short-term nature, the loan value will rise. So it's not impervious to inflation, but it's not the same as public bond risk to inflation. When we talk about what they're doing as backstops and loan losses and everything else relative to this asset class, they really are very, very prudent. A lot of them take reserves. So end client is paying 10, they take 50 basis points off. expecting that there'll be some losses, and that accrues as an asset, as a loan loss, just like banks do on the balance sheet. So it's important when you're buying into one of these funds to look at their financials, ask the questions. Do they have loan losses? What are they? What are those risks? So a lot of due diligence goes in to selecting these funds, and it's not just about, hey, I get a yield. It's really good. So again, a lot of questions have come in. This is a very, very exciting asset class. I think you absolutely need it. Our solution on this is really quite clear. We solved for the liquidity, and it's RSP eligible. The minimum investment's $500. I'd like to say our solution is democratized this, but it is only available to Q Wealth partners. If this is something you're interested in, when you get the survey, please by all means say, hey, I'm interested in becoming a client, or at least looking at this fund as part of my fixed income needs, and we'll be happy to have this. The multi-manager approach adds to the safety of this asset class. It reduces the risk of fraud, doesn't eliminate it. And we have the ability to hedge credit risks and all kinds of things that you as an individual can't do. And I think that safety is well worth it. So again, 8:30 has come. An hour and a half goes by so quickly these days. Listen, folks, 'tis the season. I wish everybody happy holidays, safety, health this time of year with family. I hope you can hug someone. If you're a snowbird, enjoy your time down south, and look forward to seeing everybody again in the new year. We'll probably pick up the version of this again around March timeframe, and go March, April, or April, May, in that timeframe where this virtual webinar will come. I hope to one day get back to do these live events again, but I can't imagine a group of 50, 60 year-old investors sitting elbow to elbow in a theater, listening to me talk. So it's virtual probably for next year as well. And again, hope to get out to live events again at some point where we don't have to worry about this terrible thing that has inflicted the world. Anyways, best of the holiday season to everybody, and thank you all, and good health to everybody.